If you're an equity investor, chances are that you're enjoying the market rally that we're in the midst of currently in India and globally. What's the way forward and what should retail investors do? To talk about that, I have with me Shibani Kurian. She's the Senior Executive Vice President with Kotak Mahindra Asset Management Company Limited. Hi, Shibani. And let's start off first by talking about this market rally that we are witnessing. What do you think are the factors behind this? And, there's, of course, the Fed commentary as well, which spoke about and reiterated the rate cuts. Do you think that's further fueling the rally?
Hello and lovely to be here. If you look at our markets, the ingredients that have supported markets are pretty much the same. Markets have moved up on the back of a trinity of factors. Firstly, strong GDP growth and economic growth trajectory, especially vis-a-vis the rest of the world. Second has been corporate earnings trajectory. And third, flows, specifically the domestic flows, which have remained strong. Now, India continues to be among the fastest growing large economies of the world, and it is expected that India would remain so for the next 5 years, and that's lending a lot of confidence to the markets. When you look at the Fed and in terms of what the expectations are, the markets are now expecting that the Fed will possibly cut rates 3 times this year, 25 basis points of rate cuts each time. Now, this is in contrast with expectations of 6 rate cuts, which were there in a few months ago. Now, if you look at our economy, inflation in India is fairly under control, and our expectation is that RBI will possibly follow the Fed where rate cuts are concerned. Now, if you look at our markets overall, while growth has been strong, one must also pay some attention to valuations. Now, in terms of valuations, large caps are trading at a slight premium to their long-term averages, while mid and small caps are trading at a considerable premium to their long-term averages. Also, if you look at the rally over the last 1 year, the mid caps, or more specifically the small caps and the micro cap rally, has been largely led by PE or multiple expansion rather than just the earnings growth trajectory. And therefore, from here on, for the markets, earnings delivery becomes extremely important. Secondly, we are also going in for our general elections, and therefore government policies, once the new government is formed, will also be a key determinant for markets from here on.
Let's talk about foreign flows. You've not mentioned that as being one of the factors behind the recent market move, but it has picked up in the month of March. Do you think going forward, this could be a determinant of how the market could move?
Yes, so foreign flows have been somewhat volatile. Yes, in the month of March, we've again started seeing FIIs turn net buyers of Indian equities. However, when we look at the FII construct, there is a lot of debate that's taking place today between India and China, specifically because the valuation differential between India and China has become very large, with India outperforming in a big way. Our view is that fundamentally and structurally, given the earnings profile as well as return ratio profile of Indian markets, this valuation differential will possibly continue. The second fact is, from an FII perspective, if you look at FII holdings, say the Global Emerging Market Fund holdings, these funds, contrary to the belief and expectations, they are not significantly overweight India. They are just about marginally overweight India. And in the past, we've seen that that overweight has been almost 200 to 250 basis points. So there is room for such institutional investors to increase weight in India. However, for us, more importantly, the domestic flows have been extremely strong with retail participation in equity markets. And therefore, the volatility that we've seen from the FII side has clearly been negated, with DIIs being strong net buyers of Indian equities.
The one sector that's been the cynosure of all eyes is the Indian IT sector. We had global major IT company Accenture reducing guidance, citing economic uncertainty. How do you see the Indian IT industry shape up from here?
So I think IT is in a fairly interesting spot at this point in time. When you look at the sector over the last, say, year and a half, the sector has seen significant turbulence and turmoil simply because of the global macro uncertainty, higher interest rate environment. However, structurally, if you look at the industry, there is considerable amount of tech disruption that is taking place. So whether it started with digital, cloud, and now Gen AI. What we are seeing is disruption in terms of technological disruption is changing how companies look at their own businesses and processes. And that provides a structural runway for growth where Indian IT services players are concerned. Many of the Indian companies are adopting new skills. They are expanding their product suite so as to be able to gain some market share where this new age tech disruption is concerned. And therefore, we believe that the structural opportunity for growth is intact. There is a tactical element to this as well. We believe now that we are at the cusp of an interest rate reversal where, as we were discussing, the Fed starts cutting rates. As the rate cut cycle ensues, you start seeing macro stability come through. Now, last year there was a lot of discretionary tech spends which were possibly postponed. As companies see macro stability over the next, say, 12, 18, 24-month period, some of that tech spend comes back, which again drives growth and profitability in the sector. And in terms of valuations, we believe that the valuations are pretty much in line with the way we have seen premium valuations for the market. So valuations are more or less in line with the broader equity markets, while the runway for growth, both structurally as well as tactically, remains strong.
And finally, your advice to retail investors. The last 1.5 year, we have seen investors actually putting in more money in mid and small cap stocks, despite the fact that there's that valuation premium. And the flows into large cap funds have been very little in comparison, of course, to mid and small cap funds. Your advice to investors and this entire phenomenon that we are seeing?
So absolutely. But if you look at the way the retail investors have started investing in equity markets, either directly or through the mutual fund route, and you look at the pie of equity investments in the net financial savings pie of a retail investor, that number is still fairly small. And you compare that with, say, developed countries like the US, that number is as high as 20-22%. So there is a long runway for growth. Yes, you're right that a lot of flows that we have seen in the last year and a half has come towards mid and small caps in terms of funds vis-a-vis the large caps. Our belief is that if you look at valuations and growth across large, mid and small, and also equities as a whole, our advice is that we should be in an asset allocation bucket, neutral towards equities, overweight on large caps where risk return is still favorable, slightly underweight on mid caps, and underweight on small caps purely on valuations. However, what we would continue to recommend to retail investors is be disciplined, look at equities from a longer term time horizon, look at asset allocation and keep your long-term investment goals in mind. And so stay invested, stay disciplined.
Thank you so much, Shibani, for that.
Thank you so much.
Stay disciplined and stay invested and ride the India economic growth story. That's the word coming in from Shibani Kurian. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.